All right, welcome back. We have about 1 more minute to go till break is over, but while we're waiting, I thought it would be fun for everybody to participate since the emoji thing I think went pretty well. What is one piece of tax jargon that you secretly Googled? You just drop that into the chat. I know there's a lot. We have a ton of tax jargon here at Holistiplan. TCJA, that's a good one. W3.
Please. I like please.
Please or
That's
peas?
my favorite. That's my favorite. Oh, peas. I read it as please.
Yeah.
I like that as tax jargon. Please.
The please limitation on.
Yeah.
Itemized.
Limit my kids from saying please before I just say no.
You know, I'll tell you, like, by the way, there was a lot of talk in the last call about like Roger coding the stuff. That was true like years ago. Like there are moments where Jeff and I would be up in the middle of the night and he's writing a tweet storm and I'm coding the stuff. Like that's not how it is now. There are actual qualified people coding in the tax stuff in Holistiplan now. So don't worry about that. It's not Roger slamming Red Bulls at 1 a.m. It's actual qualified people. But P's amendment brought to mind, you know, we had to code the entire 2017 tax code into our system because we have the option to either sunset or not. And if you recall Jeff's session, he's like, maybe you don't worry about the sunset actually happening, but we had to build that. And that meant we had to go back to 2017 that had things like the miscellaneous deductions. It had the P's limitation on itemized deductions, which was a income-based limitation that would reduce your itemized deduction. It had exemptions. Anyway, we had to code all that junk. So basically, we had to do 2 whole tax systems in our system. And I look forward to the day of deleting all that 2017 stuff. Again, I'm not making policy choices here. It's just like a code cleanup choice. But yeah. All right, there we are.
Oh, who are those?
We ready?
These guys.
These two amazing thought leaders. So I'd love to do a quick intro so I can brag about you guys a little bit. So Roger Pine is the CEO and co-founder of Holistiplan. Obviously, he's amazing. That's why he's here. He leads the thought leadership and the product development and just, you know, the entire direction of Holistiplan. And Ben Birken is our VP of customer service here at Holistiplan, and he's also the founder of Pisces Financial Advice. So love to turn it over to you. I know there's a ton of new develops on the Roth projection tool, and you're going to walk us through it. All right.
We are. That's what we're going to do. So, we're going to build on, if we jump in, not as far back as 2017, but all the way back to November, right, of last year, which feels like a million years ago, but it wasn't that long ago. Roger and I did a webinar where we excitedly talked about one of the new tools that we had inside the Holistiplan system, our Roth projection tool, where we took what was a 1-year projection tool within scenario analysis. Now we have a separate projection tool where you can do multiple years of Roth conversions and show the long-term outcome and things like that. So we're actually going to take today to build on that, to walk through a few of the new things, and we're going to do it within the context of a case study. So Roger, I'm going to share my screen. As I'm sharing my screen, is there anything that you want to share with the people as I try to remember, like, we work at a technology company and how to use technology?
Yeah, I mean, like Roth conversions are the #1 thing that people are coming to Holistiplan to do. Still, it's the most accessible tax planning strategy there is. It's a way of bringing income into the year and then getting a long-term payoff for it. For years, we kind of didn't get involved in the conversation about what is the long-term value of doing a Roth conversion. We kind of thought of ourselves as like, we're a tactical financial planning software. And so we're going to help you do the tactics of that. We're going to help you do the 1-year modeling of that Roth conversion you're going to do. Ben is going to show you our range calc feature, which a lot of people who are doing Roth conversions use to really kind of hone in on how you fill a bracket, which is still true. But advisors again and again were like, man, can you just show me how the long-term benefit of this Roth conversion plays out? And we're like, no, man, you got other tools for that. And again, advisors were like, no, you're the tool we want to do it. So finally, we were like, you know what? It's true. To really be a complete tax planning software, we need to have the full end-to-end capability of model out the Roth conversion in advance, I'm working out with the client the plan of what we're going to do. Okay. Then when we get into the years, that's when we get into the tactical. And we're going to show all this, by the way. We're going to get into the tactical. Okay. Our plan that I discussed with the client is we're filling our brackets, between retirement and taking Social Security or whatever we're going to model. And then like how do I actually get it down to the right dollar amount? Because when you're kind of in broad brush strokes drawing it up in a projection, that's different level of detail than the tactics. So anyway, we eventually have built out a full end-to-end capability of telling this story. So yeah, that's what Ben is going to try to show you in the time that we've got today.
Awesome. Thank you. So for those of you who are familiar with Holistiplan, we've got incredibly creative naming conventions for our sample folks. So this is our retiree couple, Robert and Roxanne retiree. For the purposes of today, Robert is 67, turned 68 later this year. He's already collecting Social Security. Roxanne is 66. She turned 67 this year, has not collected Social Security, but plans to do so when she turns 70. And what we're looking at here is the tax report from their 2024 tax return, because most tax planning is going to start with this baseline of, well, what happened last year, and is last year a reasonable enough assumption to at least, like our last folks talked about, what's our baseline for this year, right? And so we're going to look at Robert and Roxanne, they're only taking Social Security, and only one of them is taking Social Security, not yet at required minimum distribution age, so living off of other investments, relatively low income, in fact, incredibly low income from a tax point of view, to the point where their deductions ate away all of their ordinary income. They had a total tax of 0. They're sitting comfortably in the 10% tax bracket. So, prime opportunity here for Roth conversion in that sort of golden window where you're maybe taking Social Security, maybe not, but not yet having to take money out of your IRAs. We're going to use this as our jumping off point, right? We're going to eyeball something here that we're going to use for our, hey, I think we can do a few years worth of projections or of conversions coming off of this particular document, and then we'll fine tune it a little bit later on, like Roger said. So if I'm looking at this and I'm focusing here on this ordinary income part of this marginal tax bracket chart, I'm seeing I can probably add another $200,000 or so of ordinary income through a Roth conversion, right? Because that's what a Roth conversion is, ordinary income, right? We're taking money out of the IRA, having to pay taxes on it, and still stay within, the 22% tax bracket. Now, again, I'm not getting super detailed, right? I'm just doing an eyeball idea here. I'm going to use that as my starting point for when we move over to the Roth projections page. I think I can do, somewhere in the ballpark of $200,000, but I'm also going to have to acknowledge I might want to scale that back a little bit, because like I said, I've only got one member of this household taking Social Security. The other member is going to take Social Security in a couple of years. So maybe I do 200,000 for a few years, and then I scale it back some by the amount of the spouse's Social Security amount. So I'm just going to set that up as a backdrop. To navigate to the Roth projection tool, we have to go back into the client's household. We're going to scroll down until we see this Roth projection section, right? So it says Roth projections. We're going to walk through how you would actually do this, screen by screen, for those of you who have seen it before. So it's a good refresher for those who have never seen it before, an introduction. We're going to create a Roth projection. The first screen that we come up with is, well, what's our name? Right, we got to call a name for this, because you might have a few different projections on here, each with some slightly different assumptions. So we're going to call this 2025 sample. You might be wondering, why are you asked for a filing status within a household where there's two people? It's because we don't really know, right? This was their filing status last year, but maybe somebody was deceased, or maybe there was a divorce or something happened. So every projection is going to ask you to indicate the filing status. The start year, we're going to use 2025. And then identify the two taxpayers within the projection itself. Sometimes we get the question, why do you have the different taxpayers? Well, if you're doing married filing separately, you might want to pick one taxpayer versus the other, right? In this case, we got a married filing joint. We're going to identify taxpayer 1 as Robert, taxpayer 2 is Roxanne. The other item that is on this particular screen, Holistiplan can calculate the additional standard deduction for individuals that are over age 65. We can also calculate the additional standard deduction if somebody is blind, but we won't know that unless you tell us, right?
Ben,
so if you know that your client is blind, you would just go ahead and mark one of these buttons right here.
Real quick,
yes, Roger.
Can you zoom in a little bit, Ben?
Yeah.
We're getting a few other questions that are kind of like, okay, what about in this case, or why'd you pick 22%? We're trying to run a case study. Like your mileage may vary for your client. I mean, like, we're trying to show how we're running we're running through an example of a client who's in a low income kind of valley, and we know they're going to have higher income later,
Yeah.
22 or 12. There's a lot of good stuff discussions we could have around that. In fact, well, actually, Ben, that's a good example of our optimization piece we're going to talk about at the very end that's coming. But
Yep. So yeah, let me back up and say, even though Roger and I are both CFPs, this is not tax advice. This is not, hey, this is what you should always do in every situation. This is just us running through an example of how you can use that tool, right? Does that
correct.
seem
Yeah.
fair? Yeah. Okay.
Right.
So I've created our sample. We're going to jump to that projection here. The first time you come into the projection, you are going to be prompted to supply some additional information that we would need to know that we couldn't extract just from the tax return itself. So it's going to be a series of 3 screens. We're going to start on the first one. And the first one is really, what I just mentioned, what are the Roth conversions that we're going to be doing? And again, I'd set up what we were going to be doing ahead of time so that I didn't have to explain it again here. But the idea is, we ballparked in 2025, conversion of about $200,000. We're going to have that go. We'll set this later, but the rate of inflation we're going to use across the whole thing is 3%. That's not a prediction. That is nothing more than me picking a number, right? The key to this screen is remembering that when you enter a conversion amount, or in some other places an income amount, the system will assume that what you have entered continues in perpetuity until you tell it to stop, right? And so in this case, we're actually going to be doing 3 lines, right? We said we were going to have a $200,000 conversion. That's actually going to go through 2027, right? Because in 2028, the second spouse is going to start collecting her Social Security, which is targeted at about a $40,000 amount. So we're actually going to scale back down the conversion by a little bit, right? To stay within that where we thought might be the top of the 22% bracket. We're going to apply that and then add our final row, which is when those conversions stop, right? Because if I didn't do anything, the system is going to assume I'm going to continue doing conversions forever and ever and ever. So in my stop year, which is 2030, I'm going to say no conversions anymore at all. And then when I hit apply, my chart down below is going to map out those different conversions. So we've got a couple of years of $200,000. We scale back down. These are the inflated amounts, and then the conversions stop entirely here, right? So we've modeled our conversions. Now we need to know a little bit about asset information. And the reason we need to know about asset information is because in a screen or two, we're going to be entering a spending assumption. And that spending is going to be accomplished by the income streams that we've got. So Social Security, pension, if there was any, annuity income, if there was any, and assets. So for these 2 folks, we are going to assume $500,000 of assets. I'll go back and fix that with $300,000 of cost basis. Cost basis is important, right? Because this is a tax planning program. We need to know how much of a gain somebody is realizing when they are liquidating taxable assets so that we can apply the right tax rate to that and have that factor into the projection. On Robert's side, we're going to give him $1 million of tax deferred assets. On Roxanne's side, we're going to give her $750,000. And we're going to assume that they have some small amount of Roth already in the bank, right? So that's our asset side of things. Got to do a few more things. How much do we think things are going to grow? We're going to give these folks a 6% rate of return. That's the easy part of this screen. The more, I'll say complicated, but I think the more thoughtful part is on this right-hand side where we say the portion of the returns that are capital gains. Right? Because, when we think about returns from a total return perspective, your return is made up of growth, but also of income and right dividends and interest. So, if you believe that some portion of your returns are going to come from growth and some are going to come from dividends and interest, you'd want to indicate that because those things are going to be taxed at different times, right? Capital gains are going to be taxed when you liquidate, but income inside of a taxable account is going to be taxed in that particular year, right? So in this case, we're assuming that 20% of the returns are from capital gains, meaning 80% of the returns are going to come from income and dividends. Again, when you see a default number in here, that is not Holistiplan saying this is what you should use. That is just us saying, here's a number, right? So you want to put some thought into this about your particular portfolios for particular clients, right? Is 6% a reasonable assumption for a rate of return? Who knows? For some of you, it's spot on. For some, it's too high. For some, it's too low. Same thing is true on the other side, right? How much of your return is going to be capital gains and how much is going to be dividends and interest? This is really on you to determine what your investment philosophy and approach is going to mean for your clients. For the purposes of this case study, we're going to leave it at 20%. Some additional details about Robert. We're going to assume Robert's going to live a long time, all the way out to 100, but he is already collecting Social Security. So we're going to enter 2025. Now, last year he collected, I think it was $45,000. So internally we have to assume, we have to apply, the 2024 to 2025 cost of living adjustment was 2.5%. So that would mean in 2025, he's going to be collecting $46,125 of Social Security. For Roxanne, we're also going to have her live out to 100, but she's not going to collect Social Security until 2028. And her benefit amount in today's dollars is going to be $40,000 as well. All right. So far, so good.
Yeah. And, Ben's kind of going, it's admirable, Ben, that you're trying to like lay in some of these methodology type things, like, 20% of capital gain stuff. I mean, we're not going to be able to go into all the detail. There's another question that came up that's a little methodology-ish. We intend to do a separate webinar for the nerds who really want to dig in. And by the way, the nerds also, we've got it that at the bottom left, there's that export button, and you can actually see every single individual intermediary calculation within the Roth projection. And if you really want to dig in, it's all there. So if it seems like we're glossing over some of the math, it's not because we don't believe in the math behind it. It's just that we think it might bore people to tears, and also we only have so much time. We're trying to show the concepts of how you would build a Roth projection and then actually implement it within scenario analysis. So I apologize to the folks who want Ben to go into detail on how this number impacts that thing and all that stuff. I promise it's all there, and we have confidence in what's all there, and we try to be very transparent about what's there. I don't know if it's going to fit in with this audience in this call. I'll just leave it there.
Yeah, I think last time I checked, there were like over 1,300 people involved on the call. So, if all 1,300 are
no, you've lost like 800, Ben. Once you start talking about that 20% capital gains thing, they were just all running for the
gets
exit.
everybody. But assuming all 1,300 were still there,
man.
Yeah. Well, I mean, go Birds. But assuming everybody was still there and wants to nerd out, we will nerd out with you until you are tired of us.
In another call. We'll do
another call.
Yeah.
All right.
All right. Keep rolling. Sorry.
No problem. So last couple of variables we need to enter here. We're going to assume that they want to spend $100,000 because that's nice and round. And I said before, we're going to use a 3% rate of inflation. Last piece, one of the more challenging things for folks to wrap their heads around, but I think, this is one thing that we believe is critical. Even though we make it optional, we think people should know what we're at least trying to get at here. And that is the tax adjustment assumption for tax deferred accounts. Now, we mark it as optional, right? You don't have to turn it on, and you can turn it on and off later as you want to. But the idea here tries to get at $1 inside of a traditional IRA is not worth the same as $1 inside of a Roth IRA, right? Roger, when you were talking to, clients, when you were doing this, you would talk about the fact that, if I remember, and I'm going to paraphrase instead of quote, but, the IRS owns some of your IRA, right? There's an embedded tax liability inside of your IRA that you should probably account for somehow.
Right. And it grows every year. Their share grows every year. And so you can buy out that business partner right now. Yeah,
that's right. And so the concept of this screen, this field right here, just says if you want to see your IRA adjusted for that embedded tax liability, you can do that. And you just have to enter the single rate that you want to adjust it by, right? So we can make it 24%, we can make it 22%. Again, for the purposes of today, it doesn't matter, but we're going to leave this off for right now just to start, just so that if you want to, we can show you what it looks like when you turn it on. And we'll talk through that again. There's a whole methodology behind that. Try not to get too bogged down in that. But again, we promise you, if you want to nerd out, we will nerd out with you.
Like if the child, there's a couple ways you could look at how you enter this field, but like if the child is in a super high tax bracket, for example, well, then the child inheriting these assets would value Roth even more than a tax deferred asset, right? So, there's arguments for how you would want to model this adjustment at the end of life.
Yep. So we're gonna leave it off. We'll turn it on when we're actually inside the projection. The last one, this is kind of funny. We've been leaving this on by default for really forever. But hearing Jeff talking about it, he said turn it off. So we're gonna turn it off, right? So, but in turning it off, what I'm doing is I'm no longer assuming that the 2026 tax rate sunset, right? So we are assuming for the sake of this projection that the TCJA tax regime goes on in perpetuity, which we know will not be the case forever, but it's what we know right now, right? So we're going to do as best we can with that. When we hit complete, that is going to create a number of charts inside the Roth projection. So the first one that we see, the one that's up at the top, is the projected tax bill in our base case, which is going to be in this light green, and then the Roth conversion, which is the blue. You're going to see on this axis, that's going to be your tax bill in any particular year. And then as we scroll across, we're going from left to right, from the beginning of our projection period into the end. The Roth conversion starts with a higher tax situation because we're doing those conversions early on, but then it drops, right? On the green side, there's very little tax paid because, again, right now these folks are spending down their taxable assets. They're in a low taxable income situation, so there's a 0% capital gains rate for a lot of these things. But then we see that their annual tax bill starts to go up and up and up as we turn on both the second spouse's Social Security and as both start hitting required minimum distribution age, where they have to take money out of their IRAs, whether they want it or need it. And when you add everything up, the base projection, the total lifetime tax is about $1.9 million. On the Roth side, it's only $1 million. So we've got a projected difference of $883,000 in taxes. Now that's just the taxes side, right? That's important. But we also want to take a look at just the straight up portfolio value. And again, we've got our green base case, our blue is the Roth conversion case. And sometimes, when we started walking through this with people, I think some folks were surprised that the base case stayed ahead of the Roth conversion from a portfolio point of view for a longer time, I think, than some folks were expecting. But if you think about what's happening here, particularly with larger conversions, right? When you're doing a larger conversion and paying more taxes on that conversion, you're taking money out of the game, right? That's an opportunity cost where that tax bill that's paid no longer can compound and grow. Now, if you wait long enough with the right circumstances, you make up for it, right? So here we've got our left to right, from 2025 through the end of our projection period. It gets a little not confusing, that's not the right word. It gets a little misleading. Help me out, Roger. What's the synonym? The scale here is in $2 million increments, right? So what looks like a very small difference is actually much larger than it might otherwise appear, right? If I'm looking in between here and here, well, there's $2 million between here and here. So a very small difference here is actually going to translate to a pretty decent amount of money, right? $700,000 difference. And you see that, I think, a little bit more in the second, and this is actually why we built this second page or the second chart to expand on this. The portfolio value difference is just taking your base portfolio value minus your Roth portfolio value, right? So anytime that anything where you see a negative number in the portfolio value difference, that is when the base case with no Roth conversion has a greater amount in the portfolio amount, right? And so that's what we see here. The Roth is losing if we're just comparing portfolio values, nominal portfolio values to each other. It is less than, right? So that Roth conversion is less than until about 2048, at which point it goes positive and then goes positive, considerably, right? So about $671,000 if we modeled all the way out to the end of our scenario. Right.
Ben, some methodology things that are coming up. Just because I saw a couple of overlaps on how are you handling some of the taxes being paid out of taxable funds, but then you might have to raid the IRA to pay the taxes. Like that's all built in. And so if you had a case where you were raiding the IRA to pay taxes for the Roth conversion, that of course would look a lot worse. So again, another call, we'll go through methodology as deep as people want to go. We can go like literally line by line in the calculation. I just don't know if we're going to be able to do that to the extent people need us to today. There was a good point about could you scroll up, Ben, like that total lifetime tax difference, which is awesome, dude. That's such a cool big number, but it's true. It's future dollars. We know.
Yes. We know.
But boy, is it really impactful to sit with your client and be like $883, but it's true. That's future dollars. And so that's a roadmap thing. We haven't added it yet, but it'll be a toggle. You can discount it back. Although, you're trying to make a big impression on people, hit them with that future dollar,
Yeah. But,
actually make it way in the future. Like in the year $3,000, it's $8 trillion difference if you do the Roth.
Yeah, but we want truth, justice, and the American way
All right,
here at
go ahead.
Holistiplan, Roger. So
Keep
we'll
rolling. Keep
yes,
rolling.
know that it is on the roadmap to bring things
Yeah.
into
Yeah.
present value. So a couple of other toggles before we get to the some of the new things here. If you wanted to show, one of the advantages of doing these Roth conversions is a few lower RMDs in the future, right? So I just toggled on RMDs on the left-hand side. That is going to add a required minimum distributions chart itself, where we can see, as you would expect, the RMDs are higher in our base case, lower in the Roth conversion case, because in this case, the conversions were such a high amount that we brought down, I think, the first client's tax deferred assets to close to zero, right? You can also show for those situations where the major impact is in the end of the scenario as opposed to the beginning. If you wanted to focus on that, you can highlight the only show last 5 years toggle. We hit apply, and that is going to do some expansion. Here, now we're just looking at the last 5 years instead of starting at the 2025 year, right? So you can see that projection, that difference a little bit more magnified because we've changed our scale, right? The thing that we wanted to talk about, in addition to just giving everybody a refresher course, is we've added the ability to bring in Medicare assumptions to our projection. And we're going to walk through that again. We can get through the methodology and all this if we want to, but there are going to be two elements to Medicare that we can factor into the projection. The first is Part B. And so we want to start calculating Medicare Part B for client one. We click the box, indicate the year that somebody's going to start Medicare. And you might be wondering, why are you doing that? Doesn't everybody start Medicare at age 65? No, right? Folks that are still working at age 65 don't necessarily have to start Medicare depending on the health insurance at their employer, right? They might have to start Part A, but Part A is free, right? There's really no cost associated with Part A. Part B is a little bit different. So even though most folks will be starting at 65, we wanted to allow for those folks where they might not be starting exactly at age 65. We're going to do this
if they're on Social Security disability and they start taking it
or
early,
before, right? The second part is going to be for Part D. Right now, Part D is a little bit harder, right? We don't know what your client's Part D premium is. Your clients might not know what their Part D premium is, but they're going to be a better source than Holistiplan is. For the purposes of today, I'm going to use the average Part D premium was actually like $46.50 per month, according to the Centers for Medicare and Medicaid Services. That's going to annualize to about $560 for the year. I'm going to do that for both clients. Again, if you know your client's specific Part D premiums, you're going to want to go ahead and enter those for a little bit more accuracy. But the reason we want to enter these things is so that we can apply not just the cost of the Medicare itself, but the big bugaboo that everybody gets terrified of, IRMAA, right? These income related surcharges, where as your income goes into higher and higher brackets, and specifically it's your Medicare related modified adjusted gross income, which is your AGI plus any tax exempt income, you have to pay surcharges on top of your baseline premiums, right? And that's what we're illustrating here. Those high conversions in those first few years push these folks into a surcharge bracket where they're having to pay IRMAA, but then they drop out of it and never have to pay it again, right? Because their RMDs were brought down by so much, they have eliminated IRMAA for the rest of their situation, for the rest of their projection. In the Roth side, but in the base case, they have to pay, when they start getting into, 2024, 2045, and those RMDs are kicking them up a notch, right? Because remember, we're inflating everything all at the same rate. Now, yes, same thing is true. We're looking at a total dollar amount that is not brought back into present day. We know that is going to be that is on our roadmap for the ability for folks to be able to do that. But one of the reasons why we wanted to show this is because, one of the feedback pieces that we get so often when people are talking about Roth is like, well, what about IRMAA? What about IRMAA? What about IRMAA? Totally get it, right? IRMAA is a thing. It is a thing that is out there. But hopefully one of the values of a tool like this is for you to be able to say, yes, you are going to have to pay an IRMAA surcharge for a couple of years, but it is so you can have $700,000 more with our projection by doing these Roths, right? Now, again, this is one case. Your mileage may vary. Not everybody's going to have an optimal outcome, but it's trying to give you another tool in your toolkit to have these conversations with your client and to maybe get around some of these things that we're terrified of that might not be as scary as they really are, right? Roger, was there anything that you wanted to add here? Because if not, I'm actually going to jump back into the scenario analysis part of this
Yeah, go
tool.
ahead. As you're doing that, I'll hit. There's a theme of a few questions that I won't be able to fully address, but some of the questions are along the lines of, look, I use this other projection software, and how does this compare to that? Like, look, I haven't built a whole like who can do what chart on who can do what basically. And I'll talk a little bit at the end about our intentions with where this product goes. But I'll just say this, like one of the things you can count on underneath the covers of this projection engine is a very strong tax engine. Okay, like it's built on top of the same tax engine that you use for Holistiplan for scenario analysis, which what Ben is on now. So if I were to come up with a like one sentence differentiator is like all I know is like the foundation of the tax piece of this projection engine. If you trust what we're doing within this screen that Ben's on scenario wise, you should have confidence that we're doing the right things with taxes and with those IRMAA premiums underneath the covers. Now, all the other stuff, we can get into all those. That's where some of the differentiators could be around user friendliness. And someone wrote something about, well, I want to put a different investment strategy in the Roth account versus this. Like those are kind of the details that you can get into as you evaluate different tools. I'm just saying, like, if I were to, in one sentence, differentiate the two, look at the tax engine at the bottom. Like that's a thing that is rock solid for us. Everything else we're building on top of that, it's user friendliness, it's completeness around that sort of thing. And again, I'll get into this more at the end if there's time. Go
Yep.
for it, Ben.
So what we're now going to do is we're going to go from that zoomed out to our zoomed in, right? Scenario analysis is our projection tool where we're going to say, yeah, we had this goal of doing $200,000 of Roth conversions each year, but is it really going to be $200,000? What might I need to think about before I just blindly say a $200,000 Roth conversion, right? Makes sense for my client. So I've already created a 2025 scenario for Robert and Roxanne where I'm assuming the same level of investment income from last year. Now that might not turn out to be true later in the year. Can always go back and fine tune that. But I've adjusted Robert's Social Security for the amount that he's going to be taking this year. From here, we're actually going to go to Holistiplan's range calc tool, which is accessible in this additional options menu in the upper right-hand corner. It's the second option down. What range calc allows you to do is visually see the impact of adding increments of additional income from your existing baseline. So in this particular example, this 2025 baseline, Robert and Roxanne have taxable income of about $14,000, but no ordinary income, right? That's what this zero origin spot refers to. They are at zero ordinary income. So as we move from left to right, we are adding increments of income to that baseline amount of $0 of ordinary income. What I'm seeing is a visual representation of the taxes that will impact Robert and Roxanne with each $1,000 increment. And there's a couple of different colors going on here. The blue is going to be just the regular marginal brackets, right? So 10%, 12%, 22%, and so on. This purple reflects the fact that because they are so low income at baseline, as we add additional ordinary income, that's actually going to change the taxability of Social Security, which is in its way a tax increase, right? As we add more income, more of their Social Security benefit is going to be subject to taxation, up until the point where they hit the maximum amount of 85% of their benefit is subject to taxes, so that as I move from this point on to the right, I see the purple section disappear. What that means is as I add more income from this spot going to the right, I'm not changing taxability of Social Security anymore. The red section just has to do with the fact that as you've added more ordinary income, you're changing how capital gains are taxed, right? You've pushed taxable income up to the spot where we move from 0% to 15% taxability of capital gains. The vertical lines that you see are the thresholds where those IRMAA surcharges start, right? So as you go over by $1, the IRMAA surcharge kicks in. What I'm doing here, though, is I said I thought maybe $200,000 was going to be the right amount of a Roth conversion. If I did that, that actually puts my client in the 24% bracket, and that might not be my goal. Right, I might say I really want to keep them in the 22% bracket. So I've got to scale back some to at least $191,000 of a Roth conversion. And if I look at this still, I see I've got this brown section. This brown section indicates that I've added so much income that I'm subjecting my clients to the net investment income tax, right? Because I'm over $250,000 of adjusted gross income for a married filing joint couple. So if I don't want to do that, I've actually got to scale back to somewhere closer to, $177,000, $178,000 of a conversion. Now, if I were going to do this to completion, I would build another baseline, I'd build another scenario, and I'd enter that dollar amount. But we wanted to at least give you the visual of, okay, we thought 200 was the right answer, and that was a decent enough projection. And maybe 200 is still what I want. Maybe I don't care about the net investment income tax, but if I really wanted to stay within the 22% bracket, if that was my goal, I've got to scale this back to somewhere closer to like $190,000, $191,000. And the idea would be that you kind of have that 200,000, 160,000 conversion plan that we talked about on that first screen, but each year you're going to come back to this and fine tune that a little bit, right? It's not always going to be $200,000, right? It's going to depend on what else is happening in that particular year. So we're going from that zoomed out to that zoomed in, and now we've got kind of that more precise, this is exactly what I wanted to get at with this Roth conversion strategy.
Yeah, and Ben, Ben started with $200,000 as the the goal. Remember, we had a conversation 3 years ago with our client. They said we're going to do $200,000 Roth conversions every year, and now we're kind of getting into it. And you're sitting with the client, you're like, maybe not 200,000. Sometimes though, you're also maybe actually even more frequently, you're saying, look, let's just fill a bracket. And Ben, actually, let's go back to that 12 and the same screen. Like, let's say that your plan. This is a really good example of where range calc gives you some information that you could honestly, like advisors are probably missing if they're not, because if your plan is just, I want to add enough Roth conversion to fill up the 12% bracket, that's a super common strategy, right? Because jumping from 12 to 22 is a lot. So if your plan that you mapped out with a client was just like fill the 12% bracket, that would be an $81,000 Roth conversion. But here's the reality. The reality is you're actually paying 27% on that Roth conversion for that last few $1,000s. You're not actually paying 12%. That's what range calc is telling us. What that orange thing is telling us, just to be clear, hey, what'd you do to me, pal?
I messed it up.
What what was happening there was because I brought enough taxable income. Remember, the taxation of your capital gains is based on total taxable income. I brought enough taxable income in that suddenly my capital gains became taxable. And the more income I'm adding, the more capital gains I'm bringing up from 0 to 15%. If Ben had widened this, by the way, you'd see another orange spike going from 15 to 20, like way out, farther out. Anyway, the point is, you can model this all out in whatever software you want projection wise. And you're like, we are going to fill the 12% bracket this year. But the reality is there was some event that happened where they sold an asset. And the reality is if you did that $81,000 conversion, you were actually spending 27% on that, which was not the plan. So right now, Ben, go back to what we should actually do. We should do a Roth conversion of $58,000. That's what range calc does for us. Now we've done, again, we've taken strategic and taken it down to tactical. We've used the information we have about this year. And now we're saying, I'm going to do what was it, 57,000? I have a bad memory.
Yeah, 57.
57,000. That's the scenario we draw up. That's what we go back into scenario analysis. We share with the client, look, 57,000 is what we're going to do. And then that's how we actually implement what the plan was that we developed with the client. It's taking strategic down to tactical. For years, all Holistiplan could do was this tactical piece, which a lot of advisors value. Don't get me wrong, like that's our bread and butter. But we built the projection tool because enough advisors were saying, look, I trust you on this. I want the full experience of this Roth analysis to happen within the software. So that's why we're building out and have built out that Roth projection tool.
Yep.
All right.
And so, Roger mentioned, we've talked about this, a couple of things that are already on our roadmap. We've mentioned, the ability to express these in current dollars as opposed to just the lifetime dollars, right? So acknowledge that we want to do some present value. This is not ready for prime time just yet, but, one of the next iterations that's going to be built into this is the overlay of tax brackets, right? Tax rates on the year of the conversion so that folks can get that sense of like where those different tax brackets are going to land, right? So we've got all the different tax brackets right here. Again, this is not, don't take a snapshot of this and say like, this is exactly what tax rates are going to be, but it's us trying to give you a sense of like, what is next coming through in this Roth projection tool, because there's still a lot more that we can do. a lot of things that we're excited about, and we want to keep building on this, because what we're hearing is we like this, but we want more. We like this, but we want more, which is great. Like, we want to give you more, right? So this is also going to be coming down the pipeline. Roger, is there anything else that we want to talk about in terms of roadmap with the Roth, beyond just the, yes, we will have the nerd out methodology call for anybody who wants to bring their pencils?
No, the thing that Ben just put on screen, we're super excited about, and all the math behind the screen, behind the scenes is there. It's just a matter of putting it on the front end for a way that people can interact with it. So like the heavy lifting of what Ben has on screen is done. And then of course, what people are going to ask for, which we're excited about, is like, okay, don't make me manually fill that 22% bracket. Just tell me how much Roth conversion fills it. And then you starting to build in some like automation, optimization stuff. That's what we're super excited about. So let me come back to some of the questions that I saw about like, how does this compare to other products and all that stuff. Those other products have been in the market for 20 years, and I've used some of them myself. And so like, they're out there. But I will state our intentions maybe more clearly than I did last fall. When we had first announced this tool, by the way, we did have a Roth conversion tool, which you could attach to a scenario. Now, we've had that for multiple years. This is the ability to kind of build an independent scenario. I kind of soft pedaled last fall about what our intentions are. We don't build products for marketing purposes. We build products because we want to build a full-featured product. Like if our advisors are asking for a thing to exist, I'm not going to build a lame version of it just to say we have it and do a press release. Like, we want to build a full-featured tool, and so it needs to be as good or as better as what else is out there, or we wouldn't do it. I would argue that, again, the tax foundation of this tool is as good or better than anything out there. Again, there's pieces we need to build out on the kind of giving people more flexibility on functionality and stuff like that in terms of building in their assumptions. Why are we doing this? I said already, Roth conversions is the primary thing people are doing in our system. And the reality is, tactical tax planning does not happen in a vacuum. Like, these are, sometimes you're making a choice to bring income into a year in hopes of saving later, right? And we have to be able to show that full story. And for years we said, go use another product, but our own customers have told us they want us to build it. And also, here's another reason why we're doing it. It's freaking fun. So, like, this is why we do what we do. Like, we want to build something special. And we have visibility into building something special. Like, I see great momentum in terms of what we can do here. And that's why we love what we do. It's the adventure of building this stuff. So I would just say, watch this space. We're locked in. We're having fun doing it. That's a dangerous combination in a good way, because we're going to keep going. And so, yes, again, watch the space. And yes, if you are interested in this being the best it can be, and you feel like you want to be a part of that, yes, there'll be this methodology call, but like, let us hear from you. Like, I would love for us to build this thing together. The whole reason this exists is because you asked for it. Maybe not you personally, but an advisor like you in our software asked for it. And we got excited about it, and we're building it. And I want to make sure that we continue to listen to our customers as we do that, and make sure that it really does interact. I saw some good ideas just in the chats on like how pieces can interact across the software. So again, watch this space, but let's see people start to use it this year, and we're going to continue to trickle out our updates on how it's coming along. That's all I got, Ben.
Very cool. Laura, I believe we might need you to come back in and to officially send everybody home, because I don't think I have enough power to do that.
Right.
Yeah, I can help with that. Thank you, Ben. Thank you, Roger. It's always so great to hear from you guys, especially not just how the product works, but what is the product vision. And I think that's so important for advisors to hear, that we want to be the best in the market. We think we're the best in the market, and we're just going to keep driving towards that. So it's something that we continuously invest in, that we're going to keep investing in. All right, so this is the slide to bring us home. This is the code, the promo code. You should write it down. If you don't have it yet, take a screenshot. Web Keynote 2025. This will get you 10% off for your first year on premium. You should sign up today. Let us know how it goes. If you need help, we have a great support team. We have a great CS team. So I think that's a wrap. We'll send out the recap with the recording. We'll send out the recap email with any of the questions that didn't get answered. We had well over 100 questions, probably 200 questions or so. And so we'll pick probably 10 to 15 to answer, and then we'll send that out in the recap email. And this video will also get posted to our webinars page. So keep your eyes peeled for that. But thank you so much, everybody. It's been awesome having you here, and happy tax planning.
Thanks, Laura. Thanks, everybody.
Thank you, Laura. Thank you, everybody.
Bye, everyone.